A little bit of a confession. This isn't like a hidden secret here, at least in our office or people we talk about, but it's a confession because it goes against everything I was taught to believe as I was brought up in the industry. Welcome to How to Retire on Time, a show that answers your retirement questions. We're here to move past that oversimplified advice and get into the nitty gritty. As always, text your questions to 913-363-1234. Again, 913-363-1234. And remember, this show is just a show. It's not financial advice, so make sure you do your research. David, what do we got today?
Hey, Mike, which is more important, portfolio growth or tax minimization?
Notice the paradoxical balance. Finance is very paradoxical.
Okay, yeah, what do you mean by that?
You can have two seemingly contradictory objectives when brought together can create a genuine strength. So if you want lower taxes, don't spend money, take the lowest income possible in your retirement, and just kick that tax can down the road as long as you can.
Okay.
But that's kind of not the purpose of your money.
All right, that doesn't sound very fun.
Yeah, and then growth, when I first started in the business, whether it was a qualified account or if it was a non-qualified account like a brokerage account, it was, hey, we're going to trade this and grow it as much as you can and forget about the tax ramifications because the reality is you should be thanking us for paying taxes because we've grown your money. Very ignorant. Very, very ignorant. So let's break this down a little bit, okay? And I want to do a little bit of a confession. This isn't like a hidden secret here, at least in our office or people we talk about, but it's a confession because it goes against everything I was taught to believe as I was brought up in the industry.
Okay.
The confession is the amount of work, in my opinion, it takes to run a proper portfolio is a lot less work than I think people realize. And let me explain that.
Okay.
Let's say we've got, and I'm going to use just a hypothetical example. Let's say we've got 1,000 clients. Nice, easy number.
All right.
Okay. Let me say it differently. Actually, I'm thinking about this differently. Let's say we've got 100 clients versus 1,000 clients. So there's a different volume. It's the same amount of work to manage the portfolio, whether it's one person, whether it's a team of people. It's the same amount of work to manage the portfolio because it's infinitely applicable to all of the different clients. 100 clients versus 1,000 clients.
Okay.
With me so far?
Okay, yes. Same amount of work to maintain the portfolio for either group of people.
Because they're all in the same portfolio or portfolios.
Okay.
Now, every single client has a different tax situation. So in my opinion, as I've evolved over my career and had this enlightenment or awakening, it was a very rude awakening, most of our job, most of our time here, at least at Kedrick Wealth, is spent on tax planning, not growth. Notice how that's like, people think they're paying the advisor to grow your assets. And most people are paying a percentage of assets, this participation award, 1% of your assets, because but it's the same amount of work for them. They're probably not doing a custom portfolio for every single client. There's no way that could be done well.
Right.
No way.
Because you'd have to, there's just not enough time in the day to research each person's preferences or risk tolerance.
Yeah, average portfolio for someone today, not just in retirement, but in general, it might be like $150,000.
Okay.
So that's not much money every year. $150,000. I mean, $1,500 to manage someone's portfolio full time with a custom. Either you're not doing the appropriate amount of research and you're just winging it, or you're losing money and you can't sustain a life. You can't earn enough money for a living. So everyone has to go into certain portfolios. Growth is very, very important. But when people come to here and they say, well, hey, what's the fee really get me? Usually it's, okay, what's the net of fee performance? And that's an important metric. If you were to do a buy and hold portfolio that you manage yourself versus an advisor who's managing it for you, could the advisor get a better performance? We don't want to promise performance, but do you believe their time, their due diligence, their systems, their algorithms, their models, whatever they're doing, could that do better for you net of fees than on your own? That is a fair question.
Yeah.
But in my mind, that the performance is such an insignificant comparison compared to the amount of money they're able to save in taxes or in the growth of tax efficiency, in the making sure you're putting the right investments for tax efficiency or in retirement, how to take your money out tax efficiently. So for example, it might be like, well, let's have our portfolios or our, you're going to take a little bit from here, a little bit there, a little bit there. And when you're taking your income and you pay taxes, you have to pay taxes. That's just what it is.
Yeah.
Well, for us, it's like, okay, next year, based on the growth of the portfolio, we're going to take X amount of money from here. We're going to delay your Social Security one more year, and we're only going to take it from these positions. They've grown a lot, but you need about 100,000, 150,000 or so. If we take it out just from these two positions, that's going to help better diversify your portfolio because you had some inherited stocks. When I say inherited stocks, I mean like your pet stocks, your Amazon, you worked for Amazon, your Microsoft, you worked for Microsoft. So you're distorted into one position or a couple of positions.
Right.
We're going to take all your income from these two sources and you basically have tax-free income next year. So we're going to delay your Social Security one more year. We're going to delay your IRA to Roth conversions one more year, and they're all going to be able to continue to grow. And now you don't pay any more taxes. The ripple effect of just that 1 year, you didn't pay any taxes. You've got more assets that are staying in your IRA assets. It's easier to grow more money when there's more dollars in the account because let's say 6% of $1 million has more dollars than in your account than 6% of 800,000. Your Social Security continues to grow. That doesn't get in the way of the tax efficiency of long-term capital gains. Tax planning is the biggest part of financial management, in my opinion. When you're paying your advisor, that money you're paying, whether it's, 1%, it's $10,000 a year. If you're not getting an extensive tax plan on how to get more out of your money through taxes, what are you paying them for? Because at the end of the day, there's kind of a fixed cost of managing a portfolio, in my opinion, based on what I've seen other advisors do.
That fixed cost is just how much does it cost to research what positions the should be in the portfolio?
What's their salary? And maybe they're commission based. And if they're commission based, okay, well, how much money do you really need to do the job? And could you find a quant, pay them a fixed salary, and do the same amount of work? I mean, let's say, here's an example. Let's say you've got $1 million and you're currently paying your advisor $10,000 a year. Okay. So $10,000 a year. What if you had you and 9 other friends, so there's 10 of you, and you all got together and said, well, what if we just paid someone $100,000 a year and they just did research and we all just took their research and did it ourselves? What if you took your $10,000 a year and you just paid a couple of subscriptions at $2,000 a year and you took that research to manage it on your own? I mean, you could easily cut out advisors with the amount of research that's available to you. I mean, the reality is, in my opinion, yes, like I'm very proud of our models. I'm very proud of the research we do internally and independently on how to manage money. Very proud of that. But when I look at the fee that people pay us, I think it's more about the tax planning, the tax management, the tax filing, the tax minimization. It's the understanding of bringing the investment advice, the insurance advice, and the tax advice under one umbrella. Taxes, I think, is the biggest part of the conversation. And when people say, well, we're gonna pay you, X amount of money a month at the flat subscription rate that we do to get more out of your money, usually it's like it's less money than their 1%, which that's a good situation. But it's like, okay, well, this fee, great, you paid X amount of money a year for it, and we just saved you $10,000, $20,000, $30,000 at least in taxes. Everyone's situation is going to be different. Some people might not have as much savings. Some people might be more. But I think the taxes is if you're going to pay for a service, if you're going to pay for an advisor, that is what you should be paying for, more focused on than anything else, is the tax efficiency. And the problem is many CPAs are really just glorified tax preparers. They're not giving you investment advice because they can't.
Right.
So they're
not licensed
compromised.
to. Yeah. Okay. So to answer the question, we might lean towards tax minimization being more important than just portfolio growth.
Yeah. I mean, Warren Buffett's model is the most honest model I think that's out there. Look at how they're not an ETF. They're not a mutual fund, really. They're a holding company. Warren Buffett in his research, he's had a flat salary every year. They're just trying to grow their wealth. It's a very different fee structure if you really dive into it.
Right.
So I think there needs to be a change in how financial advisors that work with individuals are charging fees. That's my personal belief. I understand expense ratios because the volume they have to move assets. That is complicated. Expense ratios on a percentage, that makes all the sense in the world. But we're talking to an advisor. You've got an independent practice, and they got their models. You just have to kind of ask some questions.
Yeah.
I think it's very good. I'm biased in this to work with a professional who's going to ask questions you may not know to ask, as long as they have the additional scope of not just investments, not just growing your wealth, not just trying to create more money, not trying to help you get rich, but also the insurance and the taxes. If it's not that cohesive conversation, then I would ask questions.
Mm-hmm.
We'll leave it at that. I
Sure.
don't want to disparage anyone.
Sure.
We'll just leave it at that.